everybody? This is your host, Rob Keynes, with the Freedom Report. Yes, I'm back doing videos. Woohoo! And we're doing this before Memorial Day weekend. It is May 23rd, 2025. By the way, happy Memorial Day to everybody out there. And thank you for all of the people that sacrificed, whether soldiers or other, that sacrificed for this country to make it such a better place. Appreciate all the sacrifices and all the people that work, not only in the military, the police and everything else, rescue, fire rescue, first responders, but everybody that's putting forth the effort to make this country great, not only again, but just keep it great. All right, we're going to talk today about real estate. I'll get into gold and silver later, but I was going through the economic data trying to figure out what I wanted to do for today's video. And I looked at real estate and I thought, ooh, that's nasty and ugly. Let's go ahead and talk about it. So I've got some charts for you, most of this off of X, which is going to show you how bad it is. Now, I did preview this a couple months ago and I said real estate's about to crash, and it is. So we're going to just jump basically right into it. So let me get to the share screen. And here we go. All right, now we're on to Lance Lambert, which has a very interesting, sorry about that, guys, just checking my screen share. Lance Lambert published this really busy eye chart. I really want you to focus on the month and the year. So we're going to go down here to 2025, which is the last line. And then it has by month. So in April, he's saying monthly U.S. existing home sales totaled 349,000 in April 2025. We get that number from down here at 349K. Go 2025 in April, right? That's 28% below the 448,000 existing home sales we've averaged since April of 2000. So if you look at all these Aprils, it was 432, 502, 517. At the height right before the crash, in 2008, you had 606, 625, 560. It came back down to about the average in 2007 and then started to crater. And we're actually below where it was in 2008 and 2009, which was one of the worst markets ever. And if you notice a couple other things, if you just want to know where real estate's trending over time and you get one of these eye charts like this, a table chart that has years on one side and months on the other, just follow the colors. So green is up. This was the best time for the real estate market. Then we had the real estate crash. And then it kind of came around 2013 to about 2020, 2021. And after the pandemic, I think the dynamics of the economy changed and now we've got more red. Okay, so we're starting to see a lot more red, and you're starting to see the fall off at the beginning of the year. That's when a lot of people sell anyway, right? But you're starting to see that extend into where you typically would see green in a healthy market. You're starting to see red. And we'll see the rest of the year if this all fills in with pink and red. But it's not looking too good. And so the overall trend is definitely down for real estate across, all sectors, all months when compared with like the 25-year average, and even when compared with the last few years. And that right there is everything you need to know about the real estate market. I could stop this video right now and say done, and you would know, exactly where we're headed in the real estate market. But, you guys know me. I got more. So let's go talk about more. So we've got this one. This is printed by Amy Nixon. Follow her. She's in DFW, Texas, just like I am. U.S. vacation rental market collapses as second home purchases drop to the lowest level ever amid high interest rates and return to office mandates. And then we go on to Darth Powell, and we're looking at, maybe people will rent, except for rental rates are dropping. Now, if you think about it logically for a moment, if people can't buy houses because of higher prices and rates, what are they going to do? Well, they may switch to rentals, but rental prices have absolutely collapsed this year. In fact, April, I'm going to jump on a limb, because as I look at this data and say that April of this year was the tippy top of the current real estate market dating back to the 2008-2009 collapse. And this 17-year market is turning over because we're seeing April of 2025 be where all the numbers are rolling over. Now, you saw some of the numbers rolling over in the last year and a half, but you had an okay sort of market. Go look at the market. An okay sort of market. It wasn't great. It was declining. You can see a lot of green up here. That crash, a little bit of recovery, not as much. And then, it's kind of like we had the big one. We had the recession. We had a little bit of a rise, and now we're going back to a recession. So that real estate market in 2008 never really recovered from where it was. And I'm going to say, based on both the rental and the real estate sales data, that April of 2025 is where it all turned around and real estate started to just absolutely collapse. And real estate is one of the big three, investment sectors here in the United States. Real estate, bonds, and stocks. You've got other things. Certainly gold and silver is out there. Certainly you got crypto, you got businesses, you got all sorts of things. Real estate being one of the big three. Rents are falling. Why? That has to be demand and overbuild. So it doesn't matter whether it's a combination of. At this point, it's not holding up. Not enough people renting, too many rentals, prices are coming down. Apollo just released a 121-page deck on U.S. real estate and housing outlook. This is a really nice deep dive. Thanks for Boring Business for posting that. We're going to walk through it. Median age of home buyers is now 56 years old compared to 31 years old in 1981. Are the younger generations able to afford a home? No, they're not. Who can afford a home? It's the baby boomers and Gen X. So the only ones that, I'm Gen X, I'm 50, I'm in this group, I can afford a home. I actually just bought one, I'm sitting in it, right? Lots of people can't, lots of younger people can't. The income's not there. So how are they going to buy new houses? How are you going to rotate all of that old stock from the Gen Xers and baby boomers down to the millennials and Gen Zers? They're not going to buy it. They can't, and that's proved through the data. 44% of consumers today say it's a bad time to buy a house because of high interest rates. See that little chart? Mortgage rates today significantly higher than the effective rate on existing mortgage debt. Okay, that's not a good situation. A record 34% of Americans today said they would rent if they're going to move, except for the fact that they're not renting. They're just staying in their homes, or we think we're staying in their homes. I'll show you another chart here in a moment. U.S. population demographics remain a tailwind for housing demand. So we have less people that could buy a home just by population statistics, and inflation has killed their savings, and it's killed the value of their current salaries. So not only is it a inflation and a price issue and the interest rate issue, it's also a demographic issue. So if we had all these hungry buyers willing to rebuild the country and go buy houses, you may say, well, we'll have a little secular short-term downtrend, then everything will be fine and will recover. But this chart right here says, how is that going to recover? And there aren't enough people to buy the ones in the first place. We're losing population, and that population doesn't have the money. That's a double whammy. I don't see real estate having another 10-year boom cycle. We could have a 10 to 15-year crash cycle where it takes that long for it to recover. Look, after the Great Depression, it took 25 years to recover the stock markets to previous valuations. 25, and that was during a boom time. We're not heading into a boom time in America. How's real estate going to recover? If you own all this real estate, how are you going to recover? Home ownership rates have come down over the past decade. Delinquency rates for mortgages do remain low. However, those are going to spike. So that's one of the last ones is, are people paying their mortgage? Well, people will pay for their housing before they pay for other things because they have to have a house. And they're certainly paying for the housing now because they're not renting because rentals have fallen. So people are turtling in their homes just hoping things get better. So delinquencies are low now. But when things don't get better and they get worse, what's going to happen? This is going to crater off, go up. The delinquency rate's going to go up. Net migration trends were positive for states with lower state taxes, such as Florida and Texas. More expensive cost of living states saw net outflows. And that means if you're in a state which has high taxes, then your real estate market is likely to crash harder because there's less people coming in to buy the stuff you already got, much less whatever you're building. So that becomes a demographic and inventory issue. Why? Because of cost. Why? Because of interest rates, prices, and now taxes. All of those things figure into where you're going to buy a home. So regionally, you're going to see high tax states like California and some of the eastern coast, New York, crash more than you're going to see Florida and Texas. That chart was a good predictor of that. So if you're going to move and buy a house, you may not want to move to those other coastal areas or high tax rate areas because you may lose more because there's less people to buy them. And less money on the table to buy it with because of high taxes and higher prices. New and existing home sales have declined because of low inventory and higher rates. Makes sense. Mortgage refinance applications are near all-time lows. Everybody's saying, yeah, I either don't have the equity or I don't want to refinance it at that rate, so I'm going to sit there and hold. So that's going to reduce the amount of cash equity and people can pull out of their homes. So is HELOCs going to save the real estate market at these high interest rates? It might have done it in 2007, 2008. It ain't going to do it here. It ain't going to do it here. Sellers are receiving fewer offers per property. I mean, you had like 5.5 offers in 21, and now you have less than half that, 2.5 in 2025. Median age of home buyers at 38 years, over 30. So we saw that it was 51 buying all the new ones, and that skewed the entire ownership complex higher by 8 years than what it used to be in 2008. Meaning that that's the entirety of all homes, not just new sales, all previously owned homes. The age has gone up 8 years. The entire real estate market has shifted older because the young people can't afford it. So if you're older baby boomer, think you're going to sell your house and retire, who you going to sell it to? There ain't nobody to buy it at these rates. There's nobody to buy it. Buyers over the last few years have very different mortgage rates depending on where and when the home was actually purchased. So depending on what quarter, so there's variation in the market as to who can sell and who can't. And that means that not everybody, we're not doing apples to apples. I may own a house and somebody bought theirs 3 years ago, and we may have different rates, and they may be able to sell faster than I can because they're going to be able to have a lower top end sale price because of lower interest rates. Then maybe they'll take a lower sale price. I got a higher interest rates than the guy that bought it 2 years ago, so I'll probably have to have a higher price. So that's a disadvantage to me. So depending on when you bought it. So not all the inventory is the same. And that's something you want to check. If you're thinking real estate's your piggy bank and you're thinking you can sell it or refi or do whatever, you got to look at your existing rates and what you pay as compared to the rest of the market. See, you may not be in the same position your neighbor down the street or the guy across the town is in. You got to factor that in. Monthly payment on a mortgage, 30-year mortgage, is at $26.95, a record high. And it's basically been a record high since 21. What else happened in 21? The decline of offers received. And the prices went up. Why? Interest rates and prices. Share of households looking to move in the next 12 months have declined. So you're not going to get rentals and you're not going to get new home sales. People are just turtling. 40% of U.S. homes don't have a mortgage on it. That's why a lot of people are turtling. They're never going to sell their house unless they just desperate and need the cash, because you're going to have declining sale prices and they don't own a mortgage on it. They're going to want to keep it unless they're an emergency for a medical reason. They're not selling declining home property. That's their retirement. So a lot of those homes aren't going to come on the market. You say, well, that will blunt supply. It's 40% of supply that won't come. Well, some of it will come in a panic, but I'll show you in a minute how some of that supply is already hitting the market. Equity ownership value in real estate slowly climbed to $35 trillion. Equity value of the dollar, that will collapse. Home sales per real estate agent has declined significantly. Before 2003, hit a high of 55-ish. Now it's at 20, less than half. So if you're a real estate agent 17 years ago, you were doing twice the amount of sales you're doing now. That ain't good. And look at this fall off since 21. That inflection point in 21 is where you really started to see real estate market weakness, but that was kind of like this, and now it's about to fall off a cliff. Housing supply for new residential listings remains low, except that's about to change. I'll show you. New single family construction. So everything's slowing down. New housing market's not great. And housing shortage is over. Dallas, look at all the new units. New units are just being loaded on the market. People that said, including me, that thought that people would not finance out of 3% to 6% mortgages, we were right. Now they're desperation selling. They're not refinancing to have twice as much interest rate expense that they have to pay out over 30 years and slave to pay extra hundreds of thousands of dollars because it's a good financial decision. These people are listing their homes because they're in absolute unbridled panic about what's going on in the market. And that's where you're starting to see the collapse. We saw before the issues with the real estate market. We saw before the issues with the economy. I predicted the real estate market would suffer. Now what you're seeing is people in desperation who previously would never have sold their homes because they have all the equity or they don't want to sell and rebuy at a new interest rate, are selling because they have to. And this is where the crash starts. So April 2025, mark your calendars, that's where the real estate market really turned over. You had the slow decline and now you're having the waterfall, and it starts now and it's going to continue through 2025. So you've got bond rates spiking over 5% in the 30-year in Japan and the US. You've got the stock market had its recent problems and it retraced some of that, but it's still weak. And you've got the housing market in the US going into absolute oblivion. It's going into a slide into oblivion. It's what's happening. So if you're sitting in this paper system with dollars of real estate bonds and stocks, you may want to begin looking at this going, gee, I don't know. So what's going to happen? We're about to have a capital rotation event in the gold and silver are going to go bonkers. That's the moral of the story. You guys are gold and silver people mostly in my crowd, but you like it when I do macro and you like it when I look at other sectors for this reason. When you look at the data I showed you today, that's telling you you don't have time before capital rotation comes into metals, which means the metals are going to spike, which means what? You don't have time to buy them anymore. What I've been saying, I'm saying we had supply concerns in silver. We've had the run up in gold and people are buying it, not only the central banks, and now we're having the rest of the market collapse. And that's going to push fund managers and generalist investors and people that never taught gold and silver, don't know what gold and silver are, other than the fact they're pretty colors. You know, gold start school, a silver start school, that's all they know. They don't know gold and silver. They're all going to rotate into it. So where are we sitting? As these things crash, you know, gold will crash too because the derivative complex will drag that price down. Then everybody rotates into it and they go, doing. So we're sitting, I don't know how many months we have before that starts to happen, but we're sitting right there. We're on the precipice, the cusp, if you will, of all that happening. That's the update I want to bring for you. It's all you need. That's a good, 15-minute quickie. Gives you everything you need to know about what's going on in these markets and why you may want to start looking at gold and silver. That'll do it for today. Stay tuned. We got more. I'll go do a gold and silver preview next week when I get back after Memorial Day. And we'll talk about what's going on in those markets. And man, there's a lot of interesting stuff there. Now, a lot of anecdotal small stuff, but then some sneaky big stuff in there that I want to show you guys. And I may ask you to pay attention to things that other people in the gold and silver space aren't asking me to pay attention to. I think there's going to be some hidden value there. Stay tuned to the channel when we bring that out, and I think you guys will be really interested. Until then, God bless you. Have a wonderful evening. Enjoy your Memorial Day weekend. Enjoy living in the greatest country on earth, but also know that hard times are a-coming. We have to enjoy what we have now and plan for the future. Love you guys. Till next time, Rob Kientz with the Freedom Report.